Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place. Hi guys, I'm Ed Gotham and welcome to another episode of Opto Sessions. In a minute, you're going to have a technical analysis masterclass with the one and only JC Parets, founder of allstarcharts.com, where his motto is, it's not about being right, it's about making money. So JC has appeared frequently on all the big names, Bloomberg, CNBC, Wall Street Journal, CNN, and of course, Opto. I get a chance to dig into JC's no-nonsense approach to the markets, which has built him a large following over the years, as well as reviewing some key levels in the US indices and some exciting names to put on your watch list. He's an exciting guy and genuinely one of the best ones to follow on Twitter. So if you're into the stock market, which I guess you guys are, you're going to enjoy this one. Cheers. Hi, JC. Great to have you on the show. How are you doing at the moment?
I'm doing great. Thanks for having me.
That's all right, man. It's been an interesting quarter and the month's just ended. Now, I know you're a fan of the monthly bars. What's your view on the sort of major indices at the moment?
Well, let's remember, new all-time highs are just not something we see in downtrends. New all-time highs are things we see historically when we are being rewarded for buying stocks, right? And the NASDAQ Composite and the NASDAQ 100 just went out at new all-time monthly closing highs for the second consecutive month. And it's quite obvious the outperformance coming from the NASDAQ names. Why is that? Because those names are the social media stocks, the internet stocks, the internet retailers, biotechnology. Those are the ones in there, not energy and transportation and financials that make up a lot more of the S&P 500, for example. And the S&P 500 simply does not look like the NASDAQ. So that stands out as quite obvious. And then when you go sector by sector, which ones are the ones making new all-time highs, breaking out of bases? The Dow Jones Internet Index, the Biotechnology Index, the Internet Retail Index, social media. I mean, those are the names breaking out. You can see it in the NASDAQ.
And so, quite a few people have been discussing whether or not there's some weak sort of breadth in the market at the moment. In particular, I think people have been calling about S&P 500. Some of the stocks are still down quite a lot, and it's only a few of the big sort of tech companies that have been pulling it back up. What's your sort of point of view on that?
Yeah, I mean, I think anybody who says something like that just isn't looking at the market, right? It's just not doing the work because we're not seeing that at all. Quite the opposite. In fact, we're seeing more breadth expansion than we've seen in 30 years. And every time we get these breadth thrusts of extremes and positive momentum readings in terms of components, that historically is a great time to be buying stocks. Not to mention the list of stocks making new 63-day highs continues to expand. Those are basically quarterly highs, 3-month highs. You know, the stocks making 21-day highs, which is basically like a month, continues to expand as well. So, if people are saying that breadth is weakening, they're either, looking at the charts with their eyes closed or they're looking at the data upside down.
Yeah, that's a good insight into that. Even in uptrends, we see sort of retracements now and again. At this point, are you expecting some sort of pullback even in this sort of, even if it is in an uptrend, or can it just keep on pushing higher with the sort of demand in the market at the moment?
Both. I mean, listen, we're going to get pullbacks. In June, we got a whole bunch of pullbacks. And then when you see those pullbacks, what we like to do is look to see what the relative strength looks like and what areas are showing the most resiliency when the rest of the market is under pressure. And throughout June, we were noticing, right, when the stock market was selling off, it had some pretty bad days, pretty bad weeks. Which ones stood out? The internet stocks, the biotechnology stocks, social media, internet retail. Same names that were showing relative strength in March when the market was falling apart and suggested buying those names, the Zooms, DocuSign, all of those things, Regeneron, all these names, Activision, the video game stocks, doing very, very well. And those names, Snap, Peloton, and all these names just continue to do really, really well. So I think it's more a function of buying stocks that are going up and less about the indexes themselves. Because if you're worried so much about a correction in the S&P 500 and you own energy stocks, like that's probably like a terrible way to live. I'd rather be buying stocks that are going up.
And so, I mean, you've mentioned a few already, actually, but any stocks in particular that you've got your eye on, or in fact, ETFs?
Yeah, I mean, listen, go to iBuy, IBUY, which is the Internet Retail Index Fund, and just go look at the components. A lot of great names, a lot of great charts in there. Look at iPay, IPAY, which is the the Mobile Payments Index Fund. So go in there and look at those, the Squares, PayPals of the world. So go check those guys out. Something like the Dow Jones Internet Index Fund, FDN, Frank, David, Nancy. Check out those components. And then just on an individual level, what stocks do we like? I mean, look at the video game stocks, Activision, EA, those names continue to work. We like them. We think those are the areas we want to focus on, not get cute with materials and energy and industrials. For me, if we can focus less on the indexes and more on individual components that are doing well, I think that will be advantageous in the coming months.
Okay. With that in mind, have you got any preference generally between sort of ETFs or small funds that might be focused on particular sectors as opposed to individual stocks? Or is it not? It's not obviously not as simple as that, but generally, what are you sort of leaning towards more?
Yeah, so for us, the analysis is at the index and sector level. So we're looking at all of these indexes, whether we're going to trade the ETF or not. It's part of the analysis. Mm-hmm. And then we'll break it down to the individual components to buy the stocks. Our clients all have different time horizons and overall objectives for that matter, and they have different goals. So, a lot of our financial advisor clients, rather than buying Goldman Sachs or JP Morgan, rather just be in the financials ETF because that's what they do for their clients. An individual trader, a hedge fund trader, he's not going to touch the ETF because there's not enough juice in it. He'll look or she'll look for one of the components. So it really just depends on your overall objectives. Sometimes in the ETF, like a GDX, for example, is just a clean level and you could trade against, certain levels. So the ETF works, options on the ETF if you really need the juice. So I think it really depends on the situation. I normally prefer to be in the equities, but that's just me. And it depends on your objectives. There's no right or wrong answer. It just depends on what it is that you're looking for.
Yeah. And if we could just wind it back, and if you could give us a little bit of an introduction about how you got to where you are today, I think the audience really like to know how you got there.
I started as an intern at Merrill Lynch in 2003, so 17 years ago, actually. Wow, I didn't realize it was 17 years. Geez. And I fell in love with the market right away, love at first sight. And then a few years into Wall Street, I hit that proverbial fork in the road. And it's like, okay, do I study fundamental analysis? Do I learn about companies and get my CFA? Or do I want to learn more about stocks and trading and technical analysis and get my CMT? And at the time, this was like 05 maybe. Yeah, 05. And I was like, this, or 06, something like that. And I'm like, it seems like a lot more sense, technical analysis. And little did I know how important that decision would end up being. I wound up passing those exams in 2008. Talk about perfect timing. So I had some success in 08 and 09 when a lot of people were struggling, and the right people were around me to watch me succeed in that environment, and that wound up putting me in the right place down the road. I started a financial blog in 2010, which was pretty early for that back then. That was 10 years ago, and ultimately, today it's probably the most widely read research firm of all time.
That's amazing. Congrats.
Yeah, crazy.
And is it right to say that Paul Tudor Jones is one of your mentors then?
Not just me, everybody. We all read Market Wizards. We've all seen that 1987 documentary. Like, how does that not get you amped? When you hear him say certain things, talk about risk management, his success, obviously the things he's doing in Africa, so he's never met me. I mean, maybe one day I get lucky and I meet him. But, he might not know it, but he's certainly a mentor to me. And I know for a fact he's a mentor to a lot of people I know.
And if you had, one lesson that was really sort of helped you, is there something you could choose or?
Yeah, I mean, listen, I'm butchering the quote, but it's more like, it's something along the lines of like I'm focused on protecting the money I have is more important than looking and going out to get more money. I forget what the exact quote is, but something like that. It's more like playing defense is more important than playing offense, like something along those lines. Another good one is a 200-day moving average. Just for like folks at home listening, like if I can have one keep it simple, stupid risk management tool, what would it be? And Paul Tudor Jones's 200-day moving average is a great one. Bad things happen below a 200-day moving average. So I think his exact quote is, if it's below the 200-day, I'm out.
And
it'll save you a lot of headaches. That's for damn sure.
Oh, thanks very much, JC. And if we go back to sort of the current market again, thanks for giving a sort of bit of background about your history. The iShares Biotech ETF has been quite an interesting one. That's been on Twitter around quite a few people I've been following recently, because we're sort of like on the verge of a multi-year breakout. I think you've been watching that one as well. And what are those charts saying to you at the moment? Is there? I don't know if it's properly broken out yet. Is there a risk of a fake breakout, or do you see this one as a longer term trend that's emerging?
Yeah, I mean, listen, I'll give you the exact levels, but it's hard not to like a breakout like this. Look at the IBB after a monster run. I mean, this thing was up, like 400% off the lows in 2009. So in 5 years, returned like 400%, something astronomical, and then did nothing for 5 more years, which I think makes perfect sense. That was well-deserved digestion. So look at IBB. And if we're above 130, I think you could be long. And let's see, from a price target standpoint, we're looking at 180. So if we're above 130, the bet we're making is that this is a classic, bottoming process or consolidation, digestion of former gains, whatever it is you want. We're resolving higher. And what that means to us is that the demand has finally been able to absorb all of the overhead supply that has been in place and been dominating for 5 years. Us being able to proceed is evidence that that supply has dried up, and we don't see real supply coming into 180. And, that's we're talking 35, 40% higher from here.
What would be the signs that it's definitely rising above that level? Would you look for a weekly or a monthly close?
It's already above it. It's a go. Let's go, baby, all day.
You've already mentioned as well. I would like to swing back to the sectors that are interesting you the most at the moment. So there's biotech, gaming, internet retail. Any others?
Mobile payments, the internet stocks in general. Look at FDN, the Dow Jones Internet Index Fund, FDN breaking out to new highs. If we're below overhead supply, in the sector, like industrials, like materials, like energy, it's a tougher trade. Could it work? Sure. But for what? Why are you going to mess around? There's stocks that look great,
So you'd be basically, these sort of sectors be buying on any sort of weakness, just like we had recently.
Yeah, totally.
There's been a lot of chatter about tech stocks being immune to sort of COVID, and actually a lot of them is positive for because of, demand's like skyrocketed. And that's obviously coming through in the charts. Would you say that's true? Are they fundamentally just going to do well through, regardless of if it gets any worse?
Listen, I can't speak in terms of the fundamentals. I have no idea, nor do I have any interest. That's not really anything that concerns us. The price behavior speaks for itself. Is it doing well in this environment under the COVID conditions? Sure, but it was doing well before that. So you can say, oh, they're immune because of COVID, but the relative strength has been there for years. So this is nothing new. This is just a cute narrative that they can use to fill airtime to people that have nothing better to do than watch TV or whatever. You know what I mean? But it's nothing new. It's a cute story, but it's nothing new.
And yeah, so you probably answered this question as well, but your investment choices are 100% technically based. Is that right? If we say that you don't really look at any of the fundamentals because it's all,
No, I think the fundamentals are a complete waste of time. I understand the politically correct thing to say is that, technicals and fundamentals and use both, but like, I don't have a boss. I can say whatever I want. I think it's a waste of time because sure, you could do that fundamental analysis and know more about the company. But the way I look at it is you could be using that time to do more technical analysis. So it's an opportunity cost, not to mention you're diluting the information by bringing in another bias. Number two, and number three, if you're a fundamental technical fusion guy, right, and the fundamentals look good, but the chart looks terrible, you're not going to buy it. And if the fundamentals look bad, but the chart looks good, you're going to buy it. So then what do you need the fundamentals for?
Yeah. So there's some truth, do you think, in the fact that anything that has good fundamentals is all based in the charts anyway? And the charts express, well, more of the actual like demand or, you know, supply side of the market anyway.
It's the market's perception of the fundamentals. So by doing technical analysis, we're looking at the fundamentals, but we're letting everybody else do all the work.
Mm-hmm. That's an interesting way to look at it, actually. That's right. First time someone said it like that, and that makes a lot of sense. And in terms of the NASDAQ, maybe SP 500, what levels should people be looking at?
181. 181 in the NASDAQ 100, QQQ. If we're above 181, I don't want to hear a bearish thesis. We need to be buying stocks very aggressively. The S&P 500 is above 3,000. I don't want to hear a bearish thesis. We need to be buying stocks very aggressively. Those are the levels.
Okay, yeah, that's good. What's your opinion on the sort of divergence? Because obviously a lot of people have been chatting about it. Again, might be just noise. The divergence between like current market prices and the economic data, or potentially the economic data that might be coming soon. How does that influence, or does it not influence your decision at all? Does it not matter?
It doesn't matter to me because economic data is backward looking when the market is a forward looking discounting mechanism. So the market's pricing in economic data quarters from now. So to be looking at the economic data from last quarter, that seems, talk about a waste of time. That doesn't make any sense at all.
And how are stocks performing relative to other asset types at the moment? I know you keep a close eye on that sort of thing.
Yeah, you know, that's a big one. So, you know, stocks versus their alternatives like gold and bonds, for example, broke down on March the 6th in early March, right? Broke key support relative to those other two very important asset classes. And then since then, we have now reverted to that former support, if you will. So now it's like, all right, who's going to take charge? You know, it's been gold and bonds on a relative basis, bigger picture. Can stocks take charge here? That's the big question. We haven't seen that evidence yet, but they're certainly set up to. And if rates break out and bonds roll over, you know, that's you know, consistent with evidence of risk appetite for equities, not the safe haven of bonds.
Yeah. And what about gold? Is that telling you anything as well? Is it similar?
You know, we're getting close to our targets. We've been super bullish since February. It's been a great trade. You know, we took one gold stock off today, for example. It was an options trade. So, you know, the trades worked very, very well since February. We're starting to get near our levels. So I would probably start shying back a little bit and let things reset. But it's been a great trade. No complaints.
How do you choose your profit targets? And if we say this, if gold or whatever is in a strong uptrend, how do you compare that to if we're saying the NASDAQ 100 is it as well? Why are you coming out of one and you're looking the other potentially to go sort of heavily long on?
Yeah. So gold's below overhead supply from 2011, from the 2011 high. So we know there's sellers up there. There's dead bodies there, and we're getting there. You know, yesterday there's only one other month in history that closed above yesterday's close in gold on a monthly closing basis, and that was August of 2011. So we're back up to those areas now. So there's overhead supply. So I would expect to see some churning, and you know, throughout the summer, wouldn't surprise me to see a sloppy sort of mess in the gold market in terms of, because that's former overhead supply. In the case of the NASDAQ that we're making all-time highs, there is no former overhead supply. So we use Fibonacci projections that take the QQQ to 280 is our projection. That's where I think we're going.
That's really interesting. And so if there was a strong close above that previous all-time high in gold, that to you would be like, because potentially, so hitting all-time highs basically would be a bullish sort of move for gold as well. You'd be looking to
maybe not just closing at a new high. It's going to need some more, probably time.
Yeah. Okay. You say you're an intermediate term sort of time horizon trader, typically analyzing price action on weekly and monthly charts. How long do you typically hold positions for, and why do you sort of like enjoy that style of trading?
Well, we look at daily, weekly, and monthly charts. I think for me, an intermediate term time horizon is looking out weeks and months. We want to make money this quarter. So I don't care what happens today. And I certainly don't care what happens next year. I'll worry about next year. And one day doesn't make a trend. So for me, that sweet spot is that, looking out weeks and months, holding time, 4 to 12 weeks, 4 to 8 weeks, sort of that sweet spot. For me, I'm not a good day trader, and being chained to a computer all day, like that just doesn't seem like a pleasant lifestyle. And then in terms of, being a long-term investor, I don't even know what that is. Looking out next year, like, you're already talking about what you're going to do next year. Like, I don't even know what I'm having for dinner, yet alone what I'm going to be doing next year. So for me, that sweet spot, that intermediate term time horizon works for me. How do I do that? Well, on monthly, at the end of every month, I look at monthly charts. It's just 12 times a year, no big deal. Forces you to take a step back and identify the direction of the primary trends, which is what you and I are discussing here today. And we break it down to the weekly charts at the end of every week on a weekly basis. And then we look at daily charts for more tactical opportunities that fall within the framework of those longer term time horizons. So it really is that funnel down and top down approach is what we call it.
But if something was in a really strong uptrend, the Nasdaq prior to this big drop has been in that for quite some time. Are you saying you would sort of like avoid holding positions for a year or something? You'd be taking a quarterly trade or whatever multiple times during that year? Or
yeah, I would never hold anything for a year. That's just not anything we'd ever do.
And so what's the primary concern there? I'm just going to be interested in your thoughts on that.
A lot can happen in a year. So if you're buying something today because of something you think is going to happen a year from now, like a lot can change in those next 12 months. So for me, like it just doesn't make any sense. Like I just can't fathom trying to price in what's going to happen a year from now. That's too hard for me.
Too many things outside of your control that might happen.
Yeah, totally. So for me, we set a risk level, we set a price target, and then when our price target is hit, we sell it. It doesn't mean we can't re-enter. Trading is free these days, so it doesn't matter. So we can always re-enter. Like for example, like Zoom a few months ago hit our target. Reset up, we bought it again, hit our target again. Same thing happened in DocuSign, hit our target. We set new targets, hit our target again. So like there's nothing wrong with re-entering and setting another trade within the same uptrend, arguably. You know what I mean? There's nothing wrong with that.
That's a good way to look at it.
In fact, I encourage it. Why? Well, if it's working, why not?
And how, in terms of your sort of profit targets, how do you sort of define them so that you know that their potential to be hit within that time period?
Well, listen, we've got longer term targets in the longer term charts and shorter term targets in the shorter term charts, right? So that how do I set them is a combination of Fibonacci retracements and extensions, and former support and resistance is really how we set them. In order for them to fit within that time horizon, Mr. Market calls me and says, hey, JC, how long do you want to be in this stock? And then the market acts accordingly. Now, what actually happens is sometimes our target gets hit in one day. And I could be like, oh, we're going to be in this stock for a month. Nope, we were in it for one day. We can also get stopped out the very next day. We can also put out a trade that actually never even gets executed because it never breaks out above the level we're looking for, right? So, and then a stock could just do nothing and then hit its target in 6 months. That's certainly possible. I would say that volatility does play a factor. So if volatility is higher, your targets are probably going to get hit a lot quicker. And we just saw that in March and April and May. When volatility is low, it's probably going to take a little bit longer because the market likes to take an escalator up and an elevator down.
What is it about technical analysis that attracts you most to it? Why do you think it, when you had that decision earlier on in your life that you sort of went down the route of technical analysis?
Yeah, I just live by the mantra that pretty much everyone's completely full of shit and they have to prove otherwise, right? So that's kind of how I look at it. So I don't trust anybody. Sell side Wall Street analysts, like, do you trust anything they say? I certainly don't. Their track record is very good. Economists are even worse. CEOs of companies, they could be lying to you. They often are, or they could just be wrong. They could just be incorrect. That's very possible too, and does happen quite often. Earnings estimates are just that, estimates. They get revised several times over the coming quarters and even years in the case of like Macy's and other disasters. So, GDP numbers and all that stuff, and unemployment, those are just estimates that are going to get revised in the future. And again, backward looking economic data. So the truth is none of that is trustworthy data, as they say, as the coders say, garbage in, garbage out. So if that's the information you're using to make decisions with money at stake, I think you're crazy. So for me, the only truth that we can trust is price, because price is never going to lie. Because what that's saying is that a buyer and a seller both agreed to exchange perform that transaction at a given price on a given date at a specific time, and that's never going to be restated. That's never going to change. That's going to be there forever. And then the next transaction immediately thereafter and the one before also is recorded and is never going to change, and so forth and so on. And what do we know for a fact? We know that markets, the returns are not equally distributed, right? They're not at random. Markets trend. And and that can't be denied, right? You could hate technical analysis, call it voodoo or whatever. You can't deny that markets trend. You look at any chart, going back whenever, any stock, you'll see trends. Sometimes they go up for a while, sometimes they go down for a while, sometimes longer than others, but they trend. And that's why technical analysis works, because we're identifying the direction of primary trends and betting oftentimes that trend will continue. And because of that, that increases our probabilities of success, not to mention sanity.
What technical indicators are you referring to most to inform your sort of trading strategy?
Price. That's the number one technical indicator, price. Everything else is secondary.
And so would candlesticks patterns, would you say that's sort of a price indicator that you look at?
Well, a candlestick is just a way to show price. It's just it gives you more information than a bar or a line, for example. But all you're looking at is price.
And what sort of key sort of things are you looking for in the price to determine something that would be interesting to you?
Trends. Is it going up or down? Or sideways?
And are you specifically looking for things such as breakouts or previous all-time highs?
Yeah.
These are the sort of things that you're looking for in the patterns.
Of course, because think about it. What is an uptrend?
Yeah.
Higher lows and higher highs. And then so you get an uptrend, you get a nice rally over several weeks, several months, several years. And then what happens? Stocks are like human beings. They can't just run and run forever. They got to stop, take a breather, drink some water, some Gatorade, take a nap, come back the next day, digest, right? Everything, when you're working out, like you have to like stop because you can't just keep going. Yeah. Stocks are the same way. And then they consolidate and then they digest those gains. And then, as you say, they break out. And that breakout is the higher high, confirming it's still in an uptrend. So biotechnology, great example, went up 400% or something over a 5-year period, did nothing for 5 years, and is now breaking out, essentially continuing that long-term uptrend. So that's what we're looking for. It's nothing fancy, keep it simple, stupid. And
you also mentioned previously that you use RSI in some cases to support your decision-making. Is there a certain way in particular you use that to support? Is it support the sort of momentum in the trends and stuff?
Yeah, and again, to reiterate, anything that's not price is like a far second with respects to our analysis. Price is very, very important. If I haven't made that perfectly clear, momentum is just a fact of life in the market. It exists. It's part of technical analysis that actually be scientifically proven that momentum actually does exist. So we look for that momentum. We look for relative strength. I use a 14-period RSI. When RSI is getting above 70, that's evidence. Those are that's characteristic of an uptrend, right? That's what we see. So we calculate breadth measurements and try to come up with a number of how many stocks are showing those bullish momentum characteristics. And you asked me about breadth before. We just got a thrust in momentum above 70 that we hadn't seen in 30 years. So we use momentum not just on an individual basis, but collectively to gauge breadth, deterioration, or improvement.
And you've already mentioned that you also use the 200 SMA. Can you explain your hatred of the flat 200 SMA? Why should people stay away from that?
Yeah, I mean, listen, if you love headaches, trade stocks right near flat 200-day moving averages. I promise you'll get more headaches. It's just a flat 200-day moving average is characteristic of a sideways market, a range-bound market. So in markets like that, we probably maybe want to be taking advantage, betting that stocks are probably going to continue to be messy, in an environment like that. It's not worth it. Look for something that's not like that.
And can you possibly take me through your process for finding opportunities? I know you mentioned as well before that once a week you go through about 3,000 charts, just the bars.
Yeah, I mean, there's nothing like putting on some music and just going chart by chart by chart. And I'll tell you what, I call the boys and I'm like, we have our team meetings and everything. And I'm like, hey guys, run the scan. And I want to know the percentage of stocks that are doing this and doing that. And you want to know something? I do that because our institutional clients love it. And, the boys love running those numbers and all that. But the truth is, based on going through all those charts myself, I could pretty much tell you, and I'm pretty close usually to what the actual number is with whatever it is that we're doing, whether we're looking for divergences, we're looking for breakouts, whatever it is, I could pretty much get close to the number just by going chart by chart by chart. And the boys run the scans and, we get the exact numbers and we can plot it over time and all that fancy stuff. But there's no replicating, depending on what time of the day, a cup of coffee, if it's at night, glass of wine, maybe, put on some tunes and then just go one by one. Let's go, baby. Go one by one. And
do you use, you mentioned top-down approach to the markets. Are you looking at making sure that there's strong uptrends in the index before looking at individual stocks? Is that sort of what you're implying there?
Yeah, I mean, listen, it's a lot. It's a lot more comfortable to be aggressively long a stock or a group of stocks or sectors if the indexes are also going up. If the stock market's under pressure and it looks like it's going to go lower, we really need to be careful with our risk management, what stocks we're buying, why we're buying them. Because if we're in a downtrend, breakouts tend to fail. It's just what it is. So if you're buying breakouts in a downtrend in a bear market or whatever it is, like good luck with that. It's not a good strategy. So we have to tailor our decision making to the macro environment, and it's not it's when we say the top down, it's not just at the index level, but at the intermarket level, intermarket complex, and then assets. Stocks as an asset class globally, FTSE, Euro stocks, Latin America, Japan, Singapore, China. It's the whole world.
Yeah. Do you tend to stick to sort of US equities and indexes as well?
Nope. Everything in the whole world.
Oh, right. Wow. That's pretty good. And do you typically stay away from downtrends? You more sort of you like to look for uptrends? You're not shorting stocks? Or?
No, I love downtrends. In fact, I prefer them because money's made a lot faster and lost a lot faster too in downtrends, right? Because the way the markets work is that it's an escalator up, elevator down. So,
yeah.
On a downtrend, you're going to make money a lot faster. I shouldn't say I prefer them. It's just, it is what it is. I don't prefer one over the other. The idea is to identify the market environment and then trade accordingly.
Yeah.
I shouldn't say I love downtrends. It's just, it is what it is,
If it happens because it can happen really very quickly, downtrends can happen and finish. How, if you're looking at monthly charts, potentially, this snap sort of down move was over really quickly. How long do you wait until, because by the time you sort of see it's in a downtrend, it's already sort of made the moves. How do you know it's going to go down more? How do you approach that?
So we were the biggest bulls on Wall Street in the fourth quarter last year. Buy everything, buy breakouts, all of that. And then I would get asked, they're like, well, JC, what is it going to take for you to be bearish? Because a lot of people were surprised at just how bullish I was from last summer. And I'm like, well, we need to see deterioration in market breadth. We need to see fewer stocks making new highs, fewer indexes making new highs. We're seeing the opposite. We keep seeing more and more and more, right? So that's what we're seeing in the fourth quarter last year.
Yeah.
And coming to January this year, regional banks had already peaked in December. So the amount of stocks making new 52-week highs peaked on January the 16th, actually. So we were seeing fewer and fewer sectors making new highs, fewer and fewer stocks showing bullish momentum characteristics, just breadth deterioration after breadth deterioration again and again and again. So by the time early February came around, we were shorting everything in sight, sell everything, buy bonds. It was really a breadth deterioration scenario where we knew we did not want to own stocks. In fact, we were shorting them very aggressively in February, well before any crash. Not that I knew there was going to be a crash. I just knew we didn't want to own stocks. Whether stocks went sideways, down a little, or down a lot, I didn't know. But in any of those scenarios, we didn't want to own stocks. So it was less about what's going to happen and more about whatever happens, happens. We don't want to be involved sort of scenario. But I've said it before and I'll say it again. This stock market crash came after more warning signs than any stock market crash in world history. In February, the S&P made new highs, the Dow made new highs, and the NASDAQ made new highs. The Russell 2000 did not. Mid caps did not. Micro caps did not. The value line index did not. The Dow Jones Transportation Average continued to diverge negatively. Classic Dow theory sell signal. Breadth deterioration. The list of 21-day highs deteriorating. The list of 63-day highs deteriorating. The list of 52-week highs deteriorating. The list of stocks showing bullish momentum characteristics deteriorating. An expansion in new lows. Regional banks made new all-time lows relative to the S&P 500 before the market peaked. Like, I mean, I can go on and on and on, but it was quite obvious.
Okay. And so if there's a scenario, we've got the NASDAQ going up now, if other indices showed weakness, would that affect your opinion of the NASDAQ and if it could maintain the positive momentum?
Yeah, I mean, listen, they're going to move together. You know, the NASDAQ's outperforming, but they move together. Correlations are through the roof. So it's just what it is. If the S&P starts to break below 3,000, if the financials XLF is below 23, holding below 23, I think that's a problem. Copper below 255, that's a problem. You know, if those things start to happen, you know, we'll question our bullish thesis. I'm happy to. You know, I came into the year super bullish, and then that changed, you know, 3-4 weeks later. So, you know, I'm happy to change my mind. I don't care. I really don't care what happens. The S&P 500 could double or get cut in half. I couldn't care less. Gold can go to zero tomorrow. Won't matter to me. You know, so I don't have like a bias. You know, I'm too old to care what happens. I just want to be on the right side.
And when we're talking about market breadth, you just mean so various sectors when the indices are moving together in the same direction, or are they diverging? That's sort of what you're talking about. Is that right?
Yeah, breadth is like, it's what's happening under the surface, right? So if your car breaks down and you take it to the auto repair guy, right? He's not just going to look at the car and be like, oh, nice red car, it must be the transmission. No, he's got to open up the hood and see what's going on inside and see what's wrong, or if there is even anything wrong. Maybe just ran out of gas and just that's it. When you go to the doctor because you're sick, the doctor's not going to look at you and be like, oh, must be your kidneys. You know, he's got to look inside of you and see what's going on, right? In order to give a proper diagnosis. Yeah. In the stock market, it's the same thing. Sure, it's a stock market and we could trade S&P futures and the NASDAQ and what did the Dow do today and all that. But at the end of the day, it's a market of stocks. There are 500 stocks in the S&P 500. There are 2,000 stocks in the Russell 2000. So it's a market of stocks and it's a weight of the evidence. So if the indexes are making new highs, we want to see more and more sectors making new highs, more and more stocks making new highs, more and more stocks showing bullish momentum characteristics. When that's happening, that's characteristic of a bull market. That's been happening for months, right? And sure enough, we keep making new highs. Makes perfect sense. When that stops happening and we start getting a deterioration, in other words, the list of stocks making new 21-day highs, list of stocks making new 63-day highs, if that starts to deteriorate, and it will at some point, when that does, you know, we'll have to adjust our strategy. We're ready to do that. You know, ready, willing, and able. But clearly the market is in no rush, so why should we be? Yeah.
You're also known for using line charts for ratios to draw up relative performance charts.
Yeah.
What's so special about, I mean, we've been discussing a little bit, what's so special about keeping an eye on the relative performance charts? Is this mainly about the market breadth like we've been talking about?
Kind of. It's similar, but it's, you know, think about relative strength. If the stock market's under pressure, and there's a sector or a few sectors or a few stocks that are not under pressure when the rest of the market is, that's evidence of accumulation. That's institutional accumulation. That's Fidelity that has to buy a bunch of the stock saying, come to Papa, right? They are supporting that stock. So that's what we call relative strength. And that's usually a good indication of future performance because they were already buying it. So think of relative strength as like, putting a beach ball underwater, right? Like in a pool. And if you put it underwater, you could feel the beach ball pressuring up against your arms, right? And then when you release the pressure, the ball shoots up in the air. Think of the relative strength as the same thing. When stocks are pushing up against new highs while the rest of the market is under pressure, when that pressure eases up in the market, that stock's going to shoot up in a very similar way to the beach ball. That's relative strength.
Have you got an example of an interesting comparison you've made recently or been looking at recently with these line charts ratios?
Yeah, of course. We actually built on March 9th, we built something we called the coronavirus index. And it was just a list of all the stocks showing the highest momentum and relative strength. And those turned out to be monsters. Newmont Mining, Activision, DocuSign, Zoom, Shopify, Snap, all these stocks that were, showing up. I could pull up the scan actually and read off the list. But let's see, coronavirus index, all-star charts. Let's see. There it is. Look at this. So this was on March the 10th. Dollar General, Gilead, Clorox has been a monster. T-Doc, another one. Alibaba, Netflix, WeWork, Domino's Pizza. I mean, those were the names then showing relative strength.
It's like a crystal ball into the future.
Well, the relative strength often is. It's not my crystal ball. It's everybody's. It's not secret information. It's public info.
And do you use any sentiment analysis to help? Again, to not as your main thing, but does it help support in any way your decision making?
Definitely. The problem with sentiment is that it's hard to get, number one. Like, it's hard to get good sentiment data. Number two, everyone's always saying, oh, it's too this way, it's too this way. But usually it's neither, it's somewhere in the middle. So sentiment is really only truly valuable when it's at crazy extremes. And a lot of that is anecdotal, so it's really hard to quantify. But there is some quantifiable stuff like the Commitment of Traders report, National Association of Active Investment Managers. The AAII is all right, I guess. But we're also doing some work. We have the Robinhood API, and we're diving in to get some indication of a heads up when a bunch of crazy kids are buying a stock on their phones, stuff like that. We're working on it. We're always trying to improve. I'm good buddies with Jason Goffert, longtime client of his as well. I refer a lot of people to him. He does great sentiment work over at sentimenttrader.com. Shout out, Jason.
And you talk a lot about only focusing on high probability trades. Is there sort of like a checklist of stuff that determines that what is a high probability trade for you?
Well, sometimes it's a lower probability trade and you're just taking a punt and volatility's low and a stock has potential to really explode if you get it right. And you could buy a way out of the money call option that maybe the probabilities is not great, but if you're right, it's a grand slam. So it's all about finding a balance between putting on too much risk and not putting on enough risk, right? And that's an inner battle that we all have to fight for ourselves.
This segues into an interesting question. How do you approach the risk management generally then, like risk reward ratios, etc.? What are you putting into play typically?
Yeah, we got to be able to make 6 to 10 times what we're risking for it to be worth it. Wow. If it's a 2-to-1, bet on a football game or something, you know what I mean? So that doesn't make any sense. So we look for risk versus reward opportunities that are skewed in our favor, number one. Number two, when there's money on the line, we get crazy, right? We start turning into Looney Tunes. So in order to avoid your own personal, everybody thinks that the Fed is against them and that the market's against them and it's manipulated. No, you idiot. Your biggest hurdle is yourself, right? Look in the mirror. It's what's going on between the ears that you need to worry about, not the Fed. So, for me, setting where we're wrong before we enter the trade is very important, and where we're right before we enter the trade. So at the end of the day, once the trade is on, you're not a trader anymore. Now you just let the market do its thing. If it hits your target, it sells it automatically. If it breaks your risk, it sells it automatically.
Yeah.
Put in the trade, set the parameters, and whip out the popcorn.
And typically, so you only have one profit target then, really?
Not always. Sometimes there are several. Sometimes it's like, okay, and then it depends if it's equities or options. So in the case of equities, it's like, okay, we're buying it at 100. If it gets to 115, we'll take half off and we'll sell the rest at 130. But that'll be predetermined. And then in the case of options, if we're selling premium, right, collecting a credit, for example, when the potential reward hits 50% of the potential profit target, we take it off the table. In a long position, when we're putting on a debit position in options, when it doubles, we take half off the table, right? So there's price targets, and then in the options market, there's profit targets. So those are the differences.
Do you? I didn't actually realize that you traded options so much as well. Is there a preference, and why?
No, not necessarily. Well, sometimes you want to be in a stock, and the risk isn't as well defined as you'd like. You can't just put like a level and say, okay, if it breaks that level, I'm wrong. So in that case, the way to manage risk is to own premium, because if you're dead wrong and it goes to zero the next day, that's the most you can lose. So by owning premium, it's a great way to manage risk in a situation that is more difficult than you'd like. So that's one example. And sometimes the stock is just a clean risk reward, call it a day. Why, you don't want to fight time, because with options, there's an element of time involved. And then sometimes the market's in a range and you don't want to be long or short. You just want to sell straddles or something. So it's really, there are option strategies to help you in certain situations. If you're long a stock that's running into resistance, you don't want to sell the stock. You could sell premium, sell out of the money calls, collect some juice and lower your cost basis. Like, there's all sorts of great ways to use them.
And you're also a big advocate of anticipating market moves before they happen. So you obviously get the big return, and because otherwise, if you're waiting, miss out on a stock basically. And how do you make sure you set up for that sort of thing?
Yeah, well, I mean, that's the goal, right? To get in before the market moves, because once it's moved, you missed it, right? So the idea is to look for them, and we look. We use a variety of tools, like I said, breadth and momentum and relative strength and price behavior. We use all that stuff to make those determinations. Yeah.
So is there things such as you're looking for stocks that have just started a big uptrend or have reached all-time highs?
It depends on the environment. It depends more on the market environment than the stock itself. So first we have the market environment, and then we decide what kinds of stocks we're looking for.
Okay.
So sometimes they're breakouts, sometimes they're near lows, sometimes they're in the middle. I mean, it really just depends on the environment. Because if you're going to come up with just one strategy and you're always going to shove that down the market's throat, regardless of the environment, like, you're doomed to fail. The strategy shouldn't be your strategy no matter what. It should be, okay, what's the market doing? Now let's build a strategy to take advantage of that.
Awesome. And to finish up, I've just got this quick fire round. It's like 5 or 6 questions that not really needing a big answer. It's just like whatever first comes to your head.
Okay.
So the first one is top tip for newbie traders.
Try to blow up as quickly as possible so that you learn. Because it won't be until you blow up that you'll finally get it. So make sure you blow up quickly. Don't wait till you're 50 or 60 to blow up.
How do you wind down after a day's trading?
Put on some music. Open up a bottle of wine. I'm a certified sommelier, so I study wine for fun, and I drink it while I study.
Yeah. Where or who do you go through, if you do, for market insights?
Price action.
Yeah. Top tip for your younger self?
Listen more.
Do you have a favorite charting software?
So Koyfin, definitely. Koyfin, for sure. It's free. I also use Optima. They're great. Optima, they're great.
And lastly, as you mentioned, you're a fan of wine. Is there a favorite sort of red you could recommend?
Ooh, favorite red. So many good ones.
Well, a couple.
I've been drinking. I've been on a little Spanish kick lately. You can get a nice garnacha from Navarra. Is lovely. Great pricing too, because not a lot of people, I feel like, are drinking that. It's right next to Rioja. And Rioja Reserva is going to be great juice. I love it. In fact, I was drinking it last night. It's going to be priced a little bit more. You get some great stuff on the other side of the river. Check that out. And if you're in Rioja, if you like the Rioja stuff, I like Rioja Alta myself, the Tempranillo from there. Beautiful. And then if you want to go Italian, you know, the Brunellos are beautiful. The Montepulciano's amazing. If you get a Rosso of either, you're going to be able to save yourself a few bucks, and it's great juice too.
Yeah, awesome. Well, thanks very much, JC. That's been amazing. Really appreciate the time. And I was just going to say, so obviously our listeners can catch you on Twitter at All-Star Charts and online at allstarcharts.com. I think that's right. Is there anything you wanted to say before you go? I know you've got a new charting school that's out that these guys might be interested in.
Yeah, I encourage everyone, go check it out, chartingschool.com. I lay it all out. I'm very fortunate that I've become friendly. I have a podcast. If you go search All-Star Charts on iTunes, I've interviewed the best technical analysts in the world. We're over 100 episodes in. So just between learning from them, learning from my predecessors, living in New York City for so long, not to mention my own mistakes and so many of them over so many years, this isn't 6 hours. I give you everything I've learned, and you have lifetime access. So you can go through it as many times as you want.
Awesome. Well, thanks very much, man. Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.